Hey everyone, and welcome. At the very heart of all finance, there's really just one simple question. What is something actually worth? Could be a company, a house, you name it. Today we're going to build a mental toolkit to figure that out.
Okay, so let's start with a little thought experiment to kind of frame this whole thing. I want you to imagine you come across a magic box. Every single day, no matter what, it prints out a crisp $1 bill forever. So the big question is, what would you be willing to pay for a box like that?
Now, this magic box, it's not just some fantasy, right? It's actually a perfect metaphor for any asset that generates cash. Think about it. A stock that pays out dividends, a rental property that brings in rent. They're all just different kinds of money-printing boxes. Our goal here is to figure out how to put a real price tag on that future stream of cash.
Your first instinct might just be to throw out some huge number, but that's not really how finance works. We need a logical way to solve this puzzle. And that brings us to what is maybe the single most important concept in all evaluation.
This is our first huge idea, the absolute bedrock of how we value things. See, money has this hidden superpower, and that superpower is its relationship with time.
It's a concept called the time value of money. And all it really means is that a dollar in your hand right now is way more valuable than the promise of a dollar a year from now. So why is that? Well, because you can put today's dollar to work. You can invest it, and it can start earning more money for you, like right away.
I mean, it's a total no-brainer, isn't it? Of course you'd take the dollar today. You could stick it in a savings account, invest it, whatever. It's that potential to grow that gives today's money its extra juice over future money.
And just look at how powerful that growth can be. This is all thanks to something called compound interest, which is basically where your earnings start earning their own money. It's wild. That single dollar literally multiplies itself over and over. We're not talking about a small difference here. It is absolutely massive.
So, okay, we've got our first big principle down, the time value of money. But now we need a tool, right? A way to actually measure how an investment does. The most common one you'll hear about is return on investment, or just ROI.
But using it brings up this classic problem. Let me ask you this. Which is a better return? A gain of $1,000 or a gain of 25%? You can't really say, can you? It's like comparing apples and oranges. A $1,000 gain is awesome, but what if it took $1 million investment to get it? A percentage helps put everything on the same playing field.
And that's exactly what ROI does. It gives us this universal scorecard. It turns the performance of any investment into a simple percentage. That way we can actually compare any two magic boxes, no matter how different they seem at first glance.
Okay, let's look at this example. Investment A gives you a 20% ROI. Investment B gives you a 40% ROI. Now, just looking at this, investment B seems like the clear winner, right? I mean, double the return. It feels pretty obvious.
But wait a minute. What happens when we add just one more little piece of information? Time. Suddenly, we see it took 3 whole years to get that 40% return. And this, right here, is the crucial point. ROI has a massive blind spot. It completely ignores our first big principle, the time value of money. So we need something better. This is where the master tool comes into play. It's called net present value, or NPV, and it's designed to do the one thing ROI can't. It combines all of an asset's future cash flows with the time value of money to give you one single, powerful number. Now, don't let the name scare you off. It really just breaks down into 3 pretty simple steps. First, you just project all the money you think the asset will make in the future. Second, you discount those future dollars to figure out what they're actually worth to you today. And third, you just add it all up. That's it.
And here is the beautiful, simple rule for making a decision. After all that, if your final NPV number is positive, if it's anything greater than 0, it means the investment is expected to generate more value than it cost you. It's a green light.
Let's apply this to a real-world example, say a vending machine. Let's say it costs $10,000 up front, but after we project all its future profits and then discount them back to what they're worth today, we get an NPV of positive $4,704. That number tells you that this is a worthwhile investment.
So how does all this stuff apply in the real world? Well, the 2 most common magic boxes you're going to run into are stocks and bonds. They're just different ways that companies and even governments can raise money.
And the key difference between them is actually really simple. Buying a stock makes you a part owner of a company. It's definitely riskier, but the potential rewards can be much higher. Buying a bond, on the other hand, is basically like giving out a loan. You get fixed payments back, so it's generally lower risk, but it also usually offers a lower return.
So what's the big takeaway from all this? It's a whole new framework for thinking about value. Just remember these 4 things. Money's value is tied to time. ROI is a quick scorecard, but it's flawed because it ignores time. NPV is the master tool for figuring out true value, and things like stocks and bonds are just different kinds of magic boxes that follow these same rules.
And that really leaves us with one final thought. We've just unpacked the core tools for valuing pretty much anything. So the question for you is, the next time you're faced with a magic box, whether that's a stock, a new business idea, or even a big purchase, how are you going to decide what it's really worth?